two sectors that have been the talk of the town, especially in the YouTube world: semiconductors within India and data center stocks.
HDFCs, ICICIs, Bajaj's, Cholas should do well in the years ahead. The difference between men and boys or women and girls, difference between Ferrari and Swift Desire
should be visible.
And you can understand why Nestle's numbers will sustain. So rather than saying, I will buy this or that data center operator,
there are a couple of them, not too many.
Instead of finding the fellow who's running the data center, I'm saying let's find the dude who provides the real estate. So we went and invested in Mindspace ka REIT.
The third one especially.
That's why I did the podcast by the way, so that your viewers can tell me what are they finding.
We are here to ask you, Saurabh.
Today's guest is founder and CIO of Marcellus Investment Managers, Mr. Saurabh Mukherjea. In this conversation, you will learn how to go about building a solid stock portfolio for 2030. There was a lot of effort put in by me and my team to travel to Mumbai, then shoot this podcast, then get editing done, etc. So there's a lot of effort gone into this episode, and it would not have been possible without the support of our partners, Odoo. Odoo is an all-in-one business software that scales as your business needs increases. Odoo helps you to grow your business through their 45 plus apps. For example, inventory, for example, accounting, for example, invoicing, for example, website creation, and much more. Beauty is that all these apps are brought to you on a single platform, and these apps communicate with each other seamlessly, thus removing all the redundant and duplicate work, increasing the automation and efficiencies. For example, your e-commerce is linked with inventory and invoicing to manage stock flows and your billing. And then your invoicing is linked with your accounting to manage the books. Everything works together in sync so that you don't need to focus on tedious tasks and you can focus on more strategic tasks. The best part, if you want to try one single Odoo application, then it's free for lifetime. If you want to transform your business, check out Odoo. The link is in the description and in the pinned comments. With that, let's get back to our conversation. I hope you enjoy this one.
Saurabh, thank you so much for your time today.
My pleasure. Thank you.
I want to start this conversation on the theme that, let's say there is a young investor, let's say 25 to 30 years of age, and they want to invest in direct stocks, right? And they want to look at 2030 as the time horizon. So, mid to long term, they're not like trader sort of mindset, and they want to build a portfolio for, let's say, 5 lakh rupees, right? How should they go about constructing this portfolio given so much of volatility in the market? Macros have thrown a lot of challenges recently. So how do you look at 5 years down the line and start building that portfolio now? Which sectors to focus on, which sectors to avoid, right? Can you give us some colors on it, please?
So thank you for framing the question, Rahul. That kafi interesting framing of the question. So I'll give you two disclaimers, two carve-outs before I give you your answer.
Sure,
right?
sure.
The first carve-out I'm giving is, for some reason, whichever investor we are talking about, that person is saying, I don't want to invest in mutual funds, I want to do stock investing, right? Because
that's right.
To most people, my suggestion will be, if you have 5 lakhs and you're in a high stress job in your 20s, it's unlikely you'll find time to do it yourself, so put money in a mutual fund. So for some reason, this person says, I don't want to do mutual funds. That's the first carve out. Second thing is, this person says, look, I'm not a full-time investor. I won't be able to dedicate 2 weeks to research a company. All I can do over the weekend is 4 or 5 hours of reasonable reading of one annual report of a company and look at basic financial metrics on the free data that is available online, right? So that's the second disclaimer, that we are addressing a very specific type of person who's not a full-time investor, doesn't have time to do hours and hours of research, no time for that. Instead, he can do a few hours, 4 or 5 hours, and he wants to buy a stock or buy a portfolio of stocks, right? So very specific type of person. And the reason I'm giving this disclaimer is, for most people, my suggestion would be just go and buy a good mutual fund. But let's address your question head on, right? So first thing to realize is, if you want to build a portfolio for 5 years, over 5 years, the biggest influence on your compounding will be the underlying fundamentals of the company, right? So over a 5-year period, we'll come to valuations later, but over a 5-year period, starting period valuations are an important issue, but वो secondary है. First issue is the fundamentals wala compounding, right? Now, before we look at future compounding, we need to assess current fundamentals, and the basic disclaimers we have historically, the basic excluders we have said is, first is accounting, right? If a company's books don't make sense to us, we don't invest in the company. In my book, Diamonds in the Dust, Rahul, I've explained how we use 10 metrics to do forensic accounting. So for example, one of the metrics I've cited in the book is If you find a listed company whose audit fees have grown faster in the last 5 years than the company's revenues, then that's a big red flag, right? Similarly, if you find a listed company where the promoter sits in the audit committee, that's a big red flag, right? Now again, it's not easy to do this sort of forensics. It takes our team. We've got algos built around this, but even with algos, it takes our team 2 weeks to figure out BSE 500 में forensic quality कहाँ पे है. Simple metrics that your listeners can use is things like what is the level of debt on the balance sheet? Is debt equity above 1.5 to 1? I would say that's an excluder. Is everybody in the board from the same community, right? So exec directors, non-exec directors, do they all belong to the same community? That's a red flag. Thirdly, is the audit company, right? The auditor's name is given. If you Google the auditor, is there any regulatory history on the auditor? Right? Mm-hmm. Again, red flag. Right? Related party transactions. If you do Control F in any annual report, do Control F. Related party transactions. Are they more than say 10% of the cost base of the company? Red flag. Right? So these are 4 or 5 big red flags. If one of them is hit, I would say think very carefully about excluding the company from your portfolio. So first piece is assess the quality of accounting because that's the foundation of your analysis. Second piece to look at is return on capital. Is pre-tax return on capital at least 15% over the last 5 years, right? Why is pre-tax ROC 15 important? Because that means post-tax ROC is roughly 12, right? 12% is cost of capital in our country. If a company is not able to do pre-tax ROCE of 15, it's unlikely they're actually making any money. If they're not making money for themselves, it's difficult to see why the share price will go up meaningfully in the years to come, right? So first, coming to fundamentals, pehla is first one is pre-tax ROCE. Last 5 years, 15% दिखना चाहिए. We used to use 10 years, but because of COVID, right? Because of COVID, that FY20 and 21 years are damaged years and therefore difficult to apply the 10-year filter now. We still do a 5-year filter. And the third aspect on fundamentals is revenue growth. You ideally want to invest in a company where consistently over the last 5 years, you can see double-digit revenue growth. Right. So pre-tax ROCE 15, revenue growth 10. So that's the fundamental layer, right? You're trying to assess are the current numbers high, sensible, clean accounts, good ROC, good healthy revenue growth. Now next piece.
Sorry, can I just interrupt you here? I think these are very good elimination criteria rather than selection criteria. And can I just ask a few questions before you go to the next layer? So you said 3 things broadly. One is the clean accounting, and you gave us some ideas on that. Second is the ROCE. Now the ROCE piece which you said 15% or higher pre-tax. Is it you're talking about every single year, or you're saying at a CAGR basis?
So because we've reduced it to the last 5 years, right? I would say every year, basically post-COVID, every year we need to see minimum pre-tax ROCE 15.
Right.
If you don't see minimum pre-tax ROCE 15 every year, it becomes difficult to understand whether the company actually has a moated business. Right. So every single year, last 5 years, ROCE 15 ke upar. It's remember in many cyclical industries, in the cyclical boom, we'll do super ROCEs, right? The challenge is in 3-4 years that the cycle is down. If your ROCE falls to say 8, 9, 10%, it puts the future of the firm in jeopardy, and it certainly puts the growth prospects of the firm. So as soon as you do average, you pick up more mediocre companies than if you apply it every year as a minimum exclusion criteria.
Okay, got it. And also I just want to go back to your comment that you made around promoters. So you said in the beginning that if they belong to the same community,
if the entire board,
entire board,
right? So usually, right, a board will by law, a board will have to have non-execs, right? So I constantly look for companies where the non-execs come from a different community to the executive directors. The executive directors are usually the promoter and the hired executives.
Right.
If the non-execs also come from the same community, that's a red flag. It's a red flag at many levels. Firstly, it's suggesting that this community's people don't like people from other communities having positions of responsibility in the business. That means a lot of talent will get excluded in the years to come, right? Because there's no reason to believe that any one community or others, right? I don't come to office believing Bengalis will have some extra dimension of value add that other communities won't bring. And similarly, I don't expect to invest in companies where everybody on the board is a Gujarati.
Okay.
Everybody on the board is is a Telugu speaker.
Right.
So be careful of companies like that, because from a governance angle, from a talent angle, from a innovation angle, those sorts of companies tend to get challenged in the years ahead.
And right now there are no laws or regulations that prohibits it.
Yeah, I think.
I mean, it's just okay, fine.
Yeah,
it's a more
how
ethical.
do you define? Yeah, how do you define?
It's a more ethical call that a board.
And not just ethical. It's also a talent call, right? Because if a company's board is everybody from the same community, that's a red flag, because it suggests this company gives positions of responsibility only to people from that community.
Right.
Which means that good talent from the rest of the country will never come to that company, right? It's much like saying, if you're building an IPL team, suppose I'm RCB, Royal Challengers Bangalore, I'm building an IPL team. Will I build an IPL team only of Bangalore players? I don't think so, right? I want to win, so I'll build an IPL team with not just all India, but I'll also pull the best players from across the world, right? So just like an IPL team, a high-class IPL team will have diversity. 4 foreigners, I think, is the limit. 7 Indians. Within the Indians, some from North, some from South, some from West. Different languages, religions, nationalities in the heart, and will be the core of a high-class IPL team. Same applies to companies.
Right.
The best companies will have talent from all parts of the world.
Right. So sorry to interrupt you. So just bringing you back to where you were. So you said 3 criteria.
So exclusion criteria. Ho gaya. So we started with BSE 500. The accounting piece will take us down to 300 stocks.
Okay.
Then the fundamentals wala piece on ROCE and rev growth will take us down to roughly 100 stocks.
Okay.
Right. So in your journey of building a 30 stock portfolio, you're now down to 100.
Right.
So now you have to move from 100 through to 30 stocks, right? So in this, now the second step, now we've done fundamentals, the second step is to consider moats. Right? For a company to do well for the next 5 years, you have to have reason to believe that it's doing well today, and there is something special about the company which will allow it to do well over the next 5 years. Right? Now, if you don't have that much time in your hand, the best thing to do is to say, hey, look, out of the last 20 years, ROCE has by and large been above 15% consistently. There must be something special. I don't know what it is. If the numbers are good, there must be something special. Let me just go to a temple and pray that the same special thing continues for the next 5 years, whatever it is, jo bhi hai.
Right.
Okay? So that you can do, that's one approach, because if time is an issue, and it will be for many people who've got full-time jobs, and this is a part-time thing, they're trying to move from 100 to 30 stocks. If they say, well, I don't have the time to figure out why Marico is special, but hey, the numbers are good, then you just have to take history as a guide and invest, right? But ideally, what you should do is read the last few years' annual reports, read available material in the media, watch videos on that company. There's enough material now on social media, YouTube, companies' material on their own website for you to figure out what exactly is it that the company can do that the rivals struggle to do, right? So, for example, using, say, Nestle ka example, right? Nestle has a license to make infant milk powder, right? And because they have a brand which is 70, 80 years old, given that infant milk powder can't be advertised by law, it's seen as a medical product, can't be advertised, Nestle is able to sell its product because everybody grows up knowing that Nestle is the infant milk to sell to their child. So barriers to entry, what can Nestle do that others can't do? Firstly, getting a license to make infant milk powder is close to impossible. Secondly, even if you had the license to build a brand, is close to impossible because you can't advertise. And thirdly, if the first two, if you don't have a license and you don't have a brand, why will a chemist or a pharmacist keep you on infant milk powder? Nestle only will sell, and therefore you can understand reasonably. I'm giving a deliberately a simple example. You can understand why Nestle's numbers will sustain,
right,
for many, many years, because they've got a bunch of things that nobody else has, and therefore their infant milk powder will make bucket loads of money for them that will finance their growth, right? So this core aspect of a company's competitive advantage is important to understand if you want to confidently say next 5 years as well, company will do well. By the way, out of the top 100, we're now down to 100 stocks. My reading is out of the top 100, just about 30, 40 will have strong competitive advantages.
Right.
Okay, so other 60 will fall away. They would have done well last 5 years. So for example, say let's take last 5 years, because of the post-COVID bounce in the economy, several PSU banks have had a decent run, right? But difficult to see in the long run what is it that they can do that HDFC Bank or ICICI Bank cannot do.
Right.
And hence, you'd say, okay, this PSU bank's done well for the last 5 years, but having looked at it, it's not clear to me what exactly sustainable comparative advantages this bank has vis-a-vis players like HDFC Bank and ICICI Bank. And therefore, out of the 100, it should be able to get to 40 by doing, say, 3-4 hours of work on each of the companies using publicly available material on and answering the simple question, what can the said company do that rivals cannot, right? Another way I've seen my colleagues ask the question is, suppose rivals cut their prices by 20%. Will customers leave company X and migrate? Right. So that's the one way to frame the comparative advantage question. If rivals offered milk powder 20% cheaper, will parents stop feeding their infants Nestle and says, well, let's switch to the competition, right? I think you and I can answer the question relatively easily, and that in a way is a very good shortcut to answer this comparative advantage question. Okay, so now we're down to 40 stocks. The last step is to say I'm down to 40, right? We are in a bull market, valuations are punchy, and the homework exercise was to say next 5 years we have to make money. So if earnings growth in my portfolio is say mid-teens, ROCE mid-teens should translate to earnings growth of mid-teens, provided I don't get a big PE derating in the portfolio, I should be able to make a healthy return, right? So what I'm trying to avoid is a big derating in the portfolio. Why am I trying to avoid that? Because in very simple English, over the 5-year period, the return from the portfolio will be equal to the earnings growth plus whatever change in PE there is and plus the dividend yield.
Right.
If earnings growth is mid-teens, dividend yield typically with good companies is 1%, so you're at 16. You can deal with a 2% per annum reduction in the PE, which over 5 years translates into a 15% PE derating.
Right.
Har saal, every year 2% PE derating. If the PE derating is steeper than that, then your returns will go down to 13, 12, 11, 10. Right, the whole point of the exercise gradually starts getting eroded. Right, so you're willing to tolerate valuations which you think might derate a little bit, 10-15%, but it shouldn't derate more than 10-15, because if it does, it starts eating into your returns and pushes your returns towards 10%. Right now, what sort of PE can a company sustain over the next 5 years? Right, that's a $1 trillion question. The 3 ways we try to attack that question is, firstly, we look at the last 10-year average.
Right.
There's plenty of free software now which gives you in 1 second the last 10-year PE of a company. So what is the PE today versus the 10-year average? If the PE today is 10-15% above the 10-year average, I think you're all right. If the PE today is significantly steeper than the 10-year average, then you need to think a little bit more carefully. Second is, what is the company's PE relative to the peer group? Right. So baki jo comparators hai. If the other comparators, relative to other comparators, with 10-15% more premium, I think it's fine. If it's significantly more than that, again, time to take pause and think. And thirdly, what is the company's PE relative to the benchmark? So Nifty PE is around 20-21. So if the company's PE is 30, which is 1/3 more, right, then you need to be careful. Say, hey, over the next 5 years, will the company's PE come closer to the Nifty's PE, in which case I'm exposed to a big PE contraction, right? So, but 3 ways to think about the PE. Obviously, if on all 3 fronts, you come away saying, I don't see any big reason why the PE will correct by more than 10-15%, then you got good visibility, you make at least a mid-teens return from that stock investment. If you come away saying, hey, the stock looks cheap on all 3 metrics, then you should be able to make more than 15%. Right. But in that circumstance, please let me know what stock you found, because I'm struggling to find companies.
So that was my question. So I think looking at these 3 criteria, so the third one especially, Nifty at 21.
That's why I did the podcast by the way, so that your viewers can tell me what are they finding.
We are here to ask you, Saurabh, not the viewers telling you. Because your third criteria, I can tell you, right? You're saying Nifty PE of 21, 22. And if you compare that with any stock, you're going to find stocks like REC, PFC, etc. And that's about it, right? There are, I mean, so 40 has become the new 20, right? At least what I see.
Which is why it's a worrying situation.
Which is a worrying, but one could argue that, you know what, 10 year back, the economic conditions that we witnessed are no longer valid. Therefore, maybe I need to move my criteria from 10 years to maybe last 5 years post-COVID. I look at the PE comparison. That is one way to look at, because otherwise, if we put a lot of not a lot of restriction. Yes, we do identify quality stocks 100%, but at the same time, we need to get to a good list of stocks, because if I put in so many criteria, I might get to, let's say, 10 or 15 stocks.
So I think that argument, that something has changed in the last 10 years, there isn't that much substance in it, because neither India's earnings growth, in fact, India's earnings growth today is at a 30-year low. Neither India's earnings growth nor India's economic growth nor return on capital in the stock market is better than it was 10 years ago. So there isn't that much to suggest on the fundamental grounds. Much has changed. Obviously, the main thing that's changed in the last 10 years is a lot of retail investors.
Liquidity.
But the fundamentals of the economy remain whatever they were 10 years ago, marginally weaker perhaps. But there's no big change, right? There's nothing. And the second thing that's happened is basis a bunch of powerful regulatory reforms. It's become far easier, tax efficient and low cost for Indians to invest in the rest of the world. Right? And the rest of the world includes markets like North America, where earnings growth is twice as fast as India and valuations are much cheaper. So when there were very high taxes on investing abroad, even if North America was an attractive market even then, right, it wasn't relevant because we couldn't take our money there. Taxes were so high that after tax, there was nothing much left for us. But those tax issues have now been resolved, and through Gift City, through a bunch of apps, it's become actually relatively easy to do now invest globally. Plus, all the data is now available. It's arguable that actually there's even more data available on American and European companies than on Indian companies. So over 5 years, over 10 years, over 20 years, the American companies, including their mid caps, are growing earnings twice as fast as India in dollar terms. India does around $5.5 long-term EPS compounding. Those companies in America, even mid caps in America, are able to do $11, right? And then giants like Microsoft are able to do $15 ka compounding. And valuations there are at 15, 16 P. Nifty is at 20, small caps in India are 30, but West में small and mid caps are at 15, 16 P. So my reckoning is the same mental framework that we followed. We are following the same framework in our global compounders portfolio. The team which is investing from New York into our Cayman fund, and our team in Gift City is following the same framework. Clean accounts, good ROCE, good revenue compounding. Let's ask ourselves what can the company do that rivals can't, and then finally let's check valuations, that we shouldn't suffer more than a 15% PED rating cumulatively over 5 years. We're getting far more in the Western world than in India, which is why I put half my wealth, 3.5 years ago, I put half my wealth in our global compounders portfolio, because I could see the valuation argument was very compelling for all the way, I would say, up to $1 trillion. Berkshire Hathaway at $1 trillion is in our portfolio. Just imagine Berkshire's $1 trillion, they have $650 billion of cash. So if at one level you're paying for the market cap, which is around 500 billion. So on a PE basis, you're getting Berkshire for, I think, 9 or 10 times earnings, right? And I used to think, till we started to go to global compounder, I used to think that Berkshire used to compound once upon a time when I was a young man like you. But then I realized that last 3 saal mein, on us, we bought Berkshire 3.5 years ago, it's doubled on us in rupee terms. So it's not as if it was a compounder once upon a time. Even at $1 trillion, it's compounding away, and it's got nothing to do with AI or Mag 7 or anything like that, right? Straightforward compounding machine. Obviously, one of the great compounding machines, right? The in a way, the original,
one of the best in the world.
The OG compounding machine, built by the OGs Buffett and Munger. So when you look at that, you say, if I'm getting Berkshire at 9-10 P with $650 billion of cash in the American economy with global opportunities, do I really want to be buying 30, 40, 50
PE stocks in India?
Small and
Could this, now I think this is an interesting insight where you've contrasted Indian mid-cap and small-cap stocks versus US mid-cap and small-cap stocks at a very broad level. And is this the reason that FIs are not coming back to India? The way we saw the inflows maybe a year back.
Let me make the point stronger. So Berkshire, arguably, because $1 trillion market cap is a big company, let's take a classical American small cap. Right? Their typical small cap. So that would be a company like TransDigm. $20 billion market cap, which in America counts as small cap, right? $20 billion market cap. They make airline seat belts. They make
Okay.
95% of the airline seat belts in the world, right? So
Right.
they are the dominant player. Rockies are return on capital around 18-19%.
Okay.
EPS growth consistently 15%, right? Of which 4% is volume growth in seat belts, 7% is a price hike, right? 11% revenue growth. They keep outsourcing manufacturing to China, squeezing costs. 13% is PAT growth, and because they generate excess cash, they do buybacks. So 15% is EPS growth. That is available at 15-16 PE.
Okay.
Right? And it's a very stable franchise. For 20 years, TransDigm's been like this. Seat belts globally is not such a big market that, bright people from Harvard or IIT or MIT will say,
it's not
boss,
a
I don't want to be, nobody grows up saying, "Mujhe ko seat belt banana hai," right? So therefore, TransDigm is protected, compounding at $15 at 15p. So chances of a PD rating are modest, right? So that's the kind of benchmark that a FII has. So he's saying that I'm an American allocator or a Canadian or a European or a Norwegian allocator. I've got access, kind of the vanilla opportunities for me, right? Is this sort of stock. For us sitting in India, we had to do the work and figure it out. But for them, there are 30, 40 other names like this, which when I travel abroad, everybody in Europe and America knows of 30, 40 small and mid caps like this, which they can almost buy without research, because for the last 20 years, they've ratified these 30, 40. So when we go to America, right, they say, please invest with us in India. They say, what's $15 to is our benchmark, right? S&P itself is done, I think, 14% dollar. So $15 means 18 rupee. Now, it's very difficult for us to figure out or indeed convince them that 18% rupee return net of fees. Assume fees is 20%, that means 20% rupee return. 20% rupee return, so we can give you, because as soon as we then get into the specifics, EPS growth of 17, 18, maybe 22, some PD rating, then they say, that doesn't.
What is left then?
What is left, right? So that's the challenge, right? So either India generates far better earnings growth. Our 5, 10, 20-year average is $5.5, right? Half of America. Either we generate better earnings growth or we are cheaper.
Right.
Right. So if neither of those happen, very difficult for a lot of money to grow. There might be month to month, thoda sa opportunistic ETF rebalancing into India, but structurally, with growth where it is and valuations where they are, the maths is not quite there for us at the moment.
Right. And what could change this equation then? Is it the earnings
I think
growth?
2-3 things which we need to look forward to. First is, I think it looks like the US-India free trade agreement will get done. And it looks like they will get access to a lot of things in India, especially in manufacturing and in agriculture. They will get zero tariffs or very low tariffs. And hopefully we're also getting access to their end markets. So in light industrials, auto ancillaries, textiles, if we get access to America at 15, even 20% tariff rate, I think there's good reason to believe there's a large sector that can emerge, because we'll be at an advantage to China, right, in this area, right? So that's one area to look forward to, and a lot of this will be southern India and Gujarat, right? Very little, I think, is going to come to the north, mostly Gujarat, and most rest of it South India. But there's interesting opportunities to look at in engineering, auto ancillaries, medical devices, FMCG exports, processed food exports from here to over there, and can you make a 20% return? I think the second thing to look forward to is it's reasonably clear now to the government that given how the middle class has suffered in the last 5 years, right? Big jump in income tax payments, right? I think if you add just income tax payments from the middle class itself have CAGR'd at close to 20% over the 5 years, and GST also has been a hefty hit. So middle class tax payments had risen materially. Because of AI, jobs are disappearing for the middle class, and the government realized that this is not sustainable. So income tax cut, 12 lakhs ke niche, no income tax. Then the GST reforms. Thankfully, RBI started cutting as well. Then the banning of online gambling, which I thought was the right thing. And hopefully we will see curtailment of FNO participation, because FNO participation, SEBI's data is suggesting retail investors are losing $10-12 billion a year. So if they do all of this right, and I think they're now awake and alive to the challenges that the consumer slowdown has created. If they do all of this, I think we'll get a consumption revival.
Right.
Now already most of the valuations are punchy, but if earnings growth for FMCG companies start going back into high teens, right? Then I think it starts becoming more believable that at high teens, there 40, 50 ka, 50, 60 PE ka valuations can be
Justified at
can
some
be justified.
level.
At some level, stretch hai, but at least kuch to ummeed hai. And the third area is it's relatively clear that we've got an MSME challenge in our country, right? Asset quality ka Bajaj is saying, Chola is saying. So I think rate cutting cycle aage hai. RBI will have to cut. Whatever they might say in their policy statements. If published CPI inflation, right? If published CPI inflation is whatever 0.25% or whatever number the government is telling us it is, and MSME credit quality mein Bajaj and Chola are flagging challenges, then it's difficult to see how the RBI will not do multiple rounds of rate cuts. That creates good grounds to believe that strong lenders, right? The HDFCs, ICICIs, Bajaj's, Cholas, should do well in the years ahead. The difference between men and boys or women and girls, difference between Ferrari and Swift Desire,
should be visible very
हाँ
soon.
जी, and good news is high quality banks का valuation is not that crazy.
Right.
HDFC Bank valuation 9-10 months ago was incredibly attractive, and that's when people used to abuse me the most. अभी थोड़ा less attractive.
HDFC just became a problem of your life for
फिर
few
उसके बाद
months.
एशियन पेंट्स बना था. अब धीरे-धीरे हमारे प्रॉब्लम्स घट रहे हैं.
Yes.
Right, so high large cap quality में आप जा सकते हो. Especially I think the rate cutting cycle 100 bips किया RBI ने. I think there's more to come. So there's grounds to believe will be hope, but by and large, if I was watching this show, I'd be cautious of saying this is the ideal juncture of my life to begin a stock portfolio. I would say I'll do the research now, identify 30-40 good names, which clean accounts, good ROCE, good rev growth. I've read the annual report, lag raha hai moat hai, but hey, the valuation maths is a little sticky. Let me identify the names and wait for
some opportunity to emerge from a valuation
for the valuations to be punched down, and then I will start my journey. In the meantime, it's easy enough to invest abroad, and in a way the same exercise. If you're willing to do it in India,
why would you not do it
for the
other
Western
markets?
World? Pura world is your oyster. Think like an IPL team owner.
Right.
An IPL team owner is, sure he's patriotic, but he's paying whatever 20 crores for an Andre Russell. राइट उसका वो थिंक के ने रिलीज किया थिंक ऑक्शन में कम से कम 20 करोड़ में आंद्रे रसल वो खरीदेगा $3 million, एंड ही विल फाइंड 4 आंद्रे रसल्स फ्रॉम द रेस्ट ऑफ द वर्ल्ड बिकॉज ही सेइंग बॉस आपको जीतना है लाइफ में. आई एम नॉट हियर टू मेक अप द नंबर्स. मैं चैरिटी के लिए आईपीएल नहीं चला रहा, मुझे पैसा बनाना है. सो द आईपीएल टीम विल हैव 7 इंडियंस एंड 4 फॉरेनर्स, एंड आई थिंक सिमिलर शुड बी विथ योर व्यूअर्स पोर्टफोलियो. दे आर बिल्डिंग द पोर्टफोलियो टू विन इन लाइफ. And therefore, if it's a 5 lakh rupees ka portfolio, then allocating 2 lakh rupees for overseas in that context, to my mind, makes sense.
That was brilliant, Saurabh. So thank you for giving us that framework. I just also want to talk to you about the selling part of the stocks. Building the portfolio is always very good, but when to exit a stock is a challenge. And time and again, I have faced multiple challenges. Whether I'm in profits or loss, both times, it's very hard to make that decision. And having a set framework may be the one approach that I need to look for. But I just want to know, what is the framework that you guys follow at Marcellus and how that has evolved? Like, what changes have you made?
So let's start with the more fundamental triggers for selling, and then I'll come to the valuation triggers for selling, because that's the piece we've tried to learn after COVID.
Right.
So the fundamental triggers are straightforward, right? You identified a company, you felt they had moats, they had great people. But if the great people themselves start going, right, for whatever reason, I think you need to rethink. So it happened to us on Kotak Bank. So variety of circumstances, the regulator basically put a lot of pressure on the promoter, and I think 3 years or so ago, Uday Kotak ji resigned, right? And what was remarkable was not only did Uday Kotak ji resign, everybody who had grown up in Kotak with him, everybody he had trained, mentored, they also gradually resigned or retired one by one, right? So we were left with a situation where we loved Kotak Bank. We'd been long-standing shareholders, big admirers of what they have built in India. But the team we had invested in was basically the team that was no longer running the bank because of regulatory circumstances. So we said, let's think, is there now any reason to believe that this will be able to have comparative advantages 5 years hence, right? And the answer we got was nothing. Without the sort of exceptional talent that was running the firm, we felt there was no reason to believe that this bank will now compound any faster than an average bank in the country, average private sector bank in the country. And thus the exit from Kotak. When we exited Kotak, valuations weren't the issue. It was actually quite cheap. It had been beaten down because of everything around, top class people leaving. We sold largely because we just thought that the prized talent, right, capital allocation talent is very scarce. वो निकल गया है.
Right.
So that's the first type of exit, reason for selling, right? Second is, now let's come to the valuation piece, right? This was a piece that in the 5 years, from March 17 through to Diwali 2022.
Right.
Right, so sorry, March 17 to Diwali 21. 5 years from 17, 18, 19, 20, 21. 5 years we compounded at 25% in CCP. Earnings only compounded at 18%. So
Right.
the P multiple went up appreciably. In my stupidity, I didn't think that was a problem. I saw it going up, right? But I didn't think it was a problem. And then 22, 23, as we came out of COVID, as the COVID unlock kicked in, inflation went up globally. Russia went to war with Ukraine. Inflation went up globally. The Fed hiked by 5%. And through 22, 23, high PE stocks got crushed, right? And that's when we created this simple framework. We said from now on, we'll look at the franchise, the EPS growth, look at what is the scope for PE falling over the next 5 years, net the two numbers out and come to an IRR. We call it IRR, internal rate of return, but think of it simply as EPS growth minus PE change.
Right.
So when that equation gets adverse and the net number, EPS growth minus PE change, the net number starts moving towards 15, we start getting very circumspect. So an example of that would be around 1.5 years ago, Bajaj Finance was punching through 4.5, 5 times price to book. Chola was punching through 4 times price to book. We'd been long-standing holders. We love the franchise. We think, as I was telling you 2 minutes ago, that in a difficult economic climate, the champions will perform better than others in terms of asset quality. But the valuations were getting to a point when we did the maths on valuation derating, the net figure, EPS growth minus derating on valuations, the net figure was making us very uncomfortable.
Right.
So we dramatically slashed our positions in both of them around 1.5 years ago.
Okay.
Even though we love the companies, we still hold them, but the positions were pulled back in light of very rich valuations for top quality NBFCs.
Right.
So those are broadly the two sorts of things. The valuation rebalancings now have become more frequent over the last 2 years as we have tried to discipline ourselves. Then we love Bajaj Finance, but if it gets really expensive, then the scope for next 5 years for the valuation to get crushed, and thus the overall return to be low teens becomes higher, and hence let's be careful of that.
Right. So EPS growth is sort of your return metrics, and your P contraction or derating is sort of a risk factor. So now you've got a risk versus
So you're balancing. So think of the EPS growth as the long-term slope on which the stock will compound, right?
Right.
And the P multiple oscillates around it.
Exactly.
Okay. So even if EPS growth is strong and the PE multiple is weak, then it is superb, you load up, right? HDFC Bank 3 years ago,
Yes,
right?
agreed.
People are abusing the life out of us, but we said, this is no brainer, right? HDFC Bank sasta.
It will take time to...
So I will then get both the 15% say EPS growth compounding and I'll get the re-rating.
Right.
But the ulta was the case year and a half ago on the top class NBFCs. EPS growth was say 18, 19, perhaps 20 actually. EPS growth was 20. But the valuations were there, and the concern was even the EPS growth will hold up.
Can it come down?
Can the valuation crush, thus reducing my return, and hence we pared the position back.
Right. And do you guys use this as an entry-exit point? Like to build more positions?
Yeah, so that's how position sizing is
that's
done.
how you do it.
So these are the Bajaj Chola are core long-term holdings. But if it gets really expensive, where we think scope for derating, we cut the position size and reverse when it gets cheap. So HDFC Bank, we took it to 11% of our portfolio 2.5 years ago.
Right.
We said this is crazy. At HDFC Bank, 15% long-term EPS compounding. I think PE had gone down to a 25-year low.
Right.
So, you don't even need to open a spreadsheet. You looked at it and said, this is just mad. Let's just back up the truck here. And we did so, it thankfully worked out. It doesn't, I'm not saying it works out always, but by and large, if you do that, it's a sensible way to invest.
Right. Okay, this is very good one. So I'm going to find I don't know whether there are any ready-made indicators on various platforms where we could see this graph coming out automatically, or otherwise we'll have to plot it.
Yeah, you can plot it. I think a lot of platforms have free software where you can just get the
EPS
earnings growth plotted, right?
Yeah.
And then the PE oscillation around it.
Yeah.
Otherwise, to download the data in Excel and to plot it is also relatively easy, right? So for just create a slope, which is the earnings growth,
right?
And then the PE oscillates around it.
Yeah. No, this is very, very useful. Let me quickly move and get your views on two sectors that have been the talk of the town, especially in the YouTube world, the semiconductors within India and data center stocks. Any particular take that Marcellus or you personally
have? So look, I mean, 3.5 years ago, right, when we started Global Compounders, and I'm going to give you a story which I think illustrates how we think about these sorts of sectors. 3.5 years ago, I traveled around Europe talking to other people who invest in the West because I hadn't done it, right, and I needed to find other people who could do it. So, a fund manager in London told me something very interesting. He said that, look, when the Mahabharata is on, when Kurukshetra mein fighting is happening, you can't possibly say during the fighting, you will say, those are the Kauravas, those are the Pandavas.
Right.
You're not going to be able to do that. You're not going to say, that's Arjun over there, and that's Duryodhan, because until the war is over, you're not going to be able to say who's Kaurav, who's Pandav.
Right.
Once victory is declared, you say, boss, the victors are the Pandavas, right? So therefore, he said, never get into, he says his philosophy, never get into these Kaurav Pandav versus issues, right? This is, you can do it, but it's a waste of time. Instead go into the Mahabharata, go into Kurukshetra, and find the guy who's selling Gada and Talwar to both sides.
Okay.
If you really want to go to Kurukshetra, aapko jang mein jana hai, you are a guy, you want to go to battle, then go to battle, find either the Udupi restaurant which is selling to both sides, right, or the weapons dealer who's selling to both sides, depending on what sort of mindset you have.
Yeah.
Okay. So we followed that philosophy. Okay. So for example, we don't own Nvidia.
Right.
We don't own Intel, but what we do own is the entire ecosystem which manufactures chips. So ASML provides the lithography. Every chip in the world, every chip on your phone, on your laptop, on this camera that's being used for the podcast, has circuits hammered onto it.
Right.
The only company that can make those machines is ASML.
Right.
So without ASML's ultraviolet lithography machines, there will be no chips in the world. Okay. And therefore, whether it's Nvidia does well or Intel does well, ASML doesn't care, they will do well.
Right.
Regardless. Right?
Okay.
Most of these chips are made in TSMC's factory in Taiwan. So again, Nvidia ho ya Samsung ho ya Intel ka chip ho, I think Samsung might have its own factory, I'm sorry. But the rest of them come to TSMC to get the fabrication done. So that's how we've attacked the semiconductor opportunity. We want to win regardless of which chip company wins, right? And who am I to guess which chip company will win? Even our Global Compounders tech team is saying we can't second guess who will win the chip war over the next so many years. But it's easy to see that the support ecosystem will make tons of money. So Kurukshetra, don't do Kaurav Pandav, do the arms dealer. And similarly, we've taken a similar philosophy with data centers in India. So rather than saying I will buy this or that data center operator, anyway,
there are a couple of them, not too many. Yeah.
Right. Instead of finding the fellow who's running the data center, I'm saying let's find the dude who provides the real estate.
Okay.
So we went and invested in Mindspace ka REIT, because they provide the space, the facility, space, facility, is electricity supply, water supply they provide.
Right.
And we did the work and figured out this is really hard to do because it's not as if aap ek local grid say you're pulling a chota sa wire. You have to go to the state electricity board, go to the substation, get a big fat wire from the grid into the data center. You have to get incredible amounts of water supply for the chilling of the building. So it's not everybody's cup of tea to do all of that, right? So we said let's find a company which does all of that and invest in the REIT. They've got other things in the REIT as well. They've got IT parks, offices, and so on. And so that's how we are thinking of the data center opportunity in India, because the player itself, who, some will get hyperscaler contracts, some will get retail contracts. The data centers themselves, I suspect, will become a commodity business in the years to come.
Right. So that's how. So you're going ahead with the supporting stocks or companies that are helping the mainstream.
So we don't choose sides in the war. We find the suppliers to the war effort.
That's excellent. Thank you so much. I know you have a hard stop, so let me try to wrap it up. So far, it's been very, very good learning for me personally. So thank you for that, Saurabh. Let me now come to one last question, and then we move to rapid fire and finish it off in 5 minutes. When it comes to learning continuously, what sort of resources you and your team are looking, like tools, books, anything that you can give us?
I mean, I wish we had more. So I think all of us try to read as much as possible over the weekends on our flights. and there is a steady sort of group of suggestions which goes around, ye padho, ye suno. Increasingly, as I get older now, now my specs are dono hai, whatever it's called, the bifocal, or you don't see the bifocal, but effectively dono hai. So as I get older, it becomes harder and harder to read after work hours, because your eyes are so smashed after staring at some screen all day. So podcasts become that much more useful, and we've found business breakdowns. Business breakdowns to be a terrific podcast. As it is, we invest in the West, so the business breakdown podcasts give us 20-30% of the competitive advantage story, right? And it's done in a very attractive way so that you understand very quickly how a great company builds a moat. Right. The second is this podcast.
Sorry to interrupt you again. Any specific names of these podcast channels?
So Business Breakdowns is the name of the podcast. I think Colossus is the provider. They're the producer, and Business Breakdowns is the podcast name.
And they cover US companies.
They cover US, Europe. They've done several with us in India. We did Bajaj Finance for them for India. I think they Titan for them in India. Right. So they go around the world. So they give you the world's best companies, but 1 hour intense, deep on kya competitive advantage, how was it made, right? So very, very interesting, lots to learn, right? And as I said, you can listen to it sitting in a taxi or a metro or a plane. Second is a guy called David Senra. So he does a podcast called the Founders Podcast.
Right.
So he reads up, right? So he'll read up on Jensen Huang, he'll read up on Tim Cook or Steve Jobs.
Right.
So he'll go and read 5 books, 35 blogs, watch 20 videos, and then 1 hour he'll tell you why said founder, say Jensen Huang, why he is unusual, why, what are his strengths, what are his shortcomings, why has he succeeded, what are the mistakes he's made in his life. Again, in 1 hour, you get to hear about a promoter and how he's built his life, his career, for better or for worse. Third is a podcast called Acquired. Acquired. So Acquired is more about the tech world, right? So there'll be lots and lots of tech companies ka breakdown. But it's also about, there's an famous Acquired podcast on 4-hour podcast on Berkshire Hathaway. There's Acquired, I think 6-hour Acquired podcast on Amazon, right? But they're very good, right? And you can almost listen to them if you have 3-4 hours, or even if you have 2 hours, listen to an Acquired podcast, you'll learn deep knowledge. Acquired is about giving you deep knowledge about what's happening in the world of tech. So there's a bunch of books that keep coming around, and then more generally every morning I read between 5 to 6 a.m. I'll read the Indian Express, I'll read the Hindu, I'll then read the Financial Times, I'll read Bloomberg. So between 5 to 6 I read 3-4 websites, a couple of newspapers, and that's I think the usual daily news consumption. Then books over the weekend and podcasts on taxis and planes.
Right.
This is
marathon reading actually for somebody like me. I mean,
I think we wish we could do more, because that's the most valuable part of the job. But that is life.
No, this is very, very good list to start with. So thank you for that. Let me now quickly move to the rapid fire round. Few questions I'll ask you, and we just try and keep it short. So according to you, what's the biggest secret of the equity market?
It rewards nerds.
Right.
It rewards nerds.
Okay.
So it rewards sattebaz, but it rewards nerds.
Right. Okay. And there is a predictability to it then.
That it will reward nerds.
Yes. I don't know whether you predict Nifty, but I still like to ask you, Nifty by 2030, where do you see it?
I wouldn't know because see, I don't track kahan pe hai. But my submission to those watching will be that India's earnings growth in dollars will stay at that 5-6% dollar number, which means 9-10% rupee. So when 9-10% rupee compounding aayega, be careful about valuations, because with modest earnings growth, if your valuations are through the roof, then you'll end up with not even that 9-10% return.
Right. Okay. What's that one golden rule you follow when you invest in stocks?
Clean. Promoter has to be clean, right? Cleanliness, honesty, accounts, governance has to be the foundation.
Right. If you were to go to dinner with a celebrity, who would that be and why?
So I was 10 years behind Shah Rukh Khan in St. Columba School. So I was in class 3 when he got the Student of the Year award. It's called Sword of Honor. He came in the school magazine. So unfortunately, I couldn't speak to him then. It was 1983. I was in class 3. The great man he was finishing class 12. And then obviously he became the
Shah Rukh Khan.
world's biggest mega star. Would love to have dinner with Shah Rukh Khan. Ki boss kaise karte
So
ho?
have you actually approached him?
No, I've never had the good fortune to approach him. So love to know, because I think leaving aside what is stardom in Bollywood, which itself is something to behold over 30 years now, right? 30
Yeah,
years
more than that.
more
I
than
think.
30 years.
Yeah.
His business acumen is also very sharp, right? So the way he's built KKR, the way they've extended the KKR franchise to America, South Africa, I think West Indies में उनका KKR का franchise है. Then whole Red Chilies entertainment का how in the Bollywood ecosystem, special effects में और equipment में these guys have a comparative advantage. It's a very well thought through business empire plus he's doing his Bollywood stuff, and I'm presuming it's not just the movies we watch. I presume there's plenty of other live shows and post production and advertising, etc. So how he has built this incredibly interesting empire, right? It might not be a $1 trillion empire. It's probably a multi-billion dollar empire, but it's very interesting to watch. And because I went to the same school as him and I grew up in the same city, and the school we went to was known for sports, extracurricular. Shah Rukh Khan excelled at all of that. Right? We were not the most cerebral school in Delhi. But I was once in the school where if you wanted to get into IIT JEE top 10, you would come and work your back flat. You would come to our school. You'd come to St. Columbus for building a more sort of broad personality. To see him have so much success is inspiring. So काफी लोग बोलते हैं वॉरेन बफेट जी की श्रद्धा करता हूँ and उनकी किताबें पढ़ सकते हैं. There isn't a biography of Shah Rukh Khan which has gone into the psyche of how this man has built this remarkable empire.
And also, I think, if I may add, he started from nothing almost. So that is quite impressive because it's a very regular and that does tell people that you could do whatever you want.
It's very, very interesting. So अगर शाहरुख जी अगर आप ये podcast watch कर रहे हो, तो
definitely not. Definitely
चाय
not.
पिला दीजिएगा at least.
But thank you so much, Saurabh.
My pleasure.
I think I'm taking a lot of learnings from this. I hope my viewers are also definitely the resources that you talked about, the podcast, and also the criteria for the elimination of the stocks, because a lot of us get trapped sometimes into stocks that are the talk of the town, and we ignore the valuations because we get trapped into the hype. So that was my intent, to bring that balance into our stock selection. And I think, Saurabh, you've given us a very good, clean framework of accounting, ROCE, rev growth, and then look at the EPS and then followed by valuation. So thank you so much.
Thank you so much. Thank you.
Thank you.